Lindsay, what is your word of the day? How do you see today shaping up?
Well, my word of the day today is peace, in honor of President Jimmy Carter and all the peace that he's brought around the world. He spent much of his post-presidential career focused on peace, economic progress, and human rights. And he even won a Nobel Peace Prize in 2002. So my word of the day is peace. I think we can all hope for more peace in the world.
All right, a very appropriate word of the day for today. I do want to talk about something else, volatility in the equity markets and also in the bond markets. We've seen quite a bit of that, not only here in the U.S., but globally. As someone who manages money, how are you playing that? Some of these dips that we've seen, are they buyable dips, or do you think there's more volatility to come?
I do think that some of these dips should be bought. I'm not saying that you should go in hand and over fist to buy, but I think you should nibble on some of the dips. I think the volatility is going to continue, especially as policy uncertainty remains a key theme, especially in the early days of President Trump's second term. And so I think that it's going to be it's going to create opportunity for investors.
All right, speaking of opportunities, do you see opportunities in the bond market? I've been talking to a lot of investors. A lot of people think that right now is a great time to buy treasuries, specifically the belly, kind of the middle of the curve.
Yeah, sure. I think there's absolutely opportunity there. Every investor should always have some component of their portfolio in fixed income, and I do think that that's a smart place to be right now, especially the fact that we're going to start to see interest rates stabilize here. We've got a central bank that is less likely to continue cutting and more likely to remain seated.
All right, so inflation is obviously one big issue, at least for our central bank, something they're watching very closely. I want to get your take on what Treasury Secretary Janet Yellen said yesterday here on CNBC when it comes to inflation.
The rate of inflation has come way down. It's now pretty close, quite close to the Fed's target. So prices aren't continuing to rise at anything like that pace. It's now very close to normal.
All right, so that's what Janet Yellen had to say. Agree or disagree with what she had to say? And then I want to get your take on the Fed minutes and what Fed officials actually had to say.
Yeah, I think that we've made a lot of progress over the last couple of years in inflation, but it has been sticky for the latter part of 2024. And I think there's some survey work, some of the PMI data, whether it's in manufacturing or services, and some of the wage data that we've seen from the labor market has shown inflation that could potentially be sticky to continue to tick up slightly. So I think there's more work to do on inflation here.
All right, so you think there's more work to do on inflation. In the minutes yesterday, we found out the Fed officials, they're looking at stronger than expected readings. They're also taking into consideration some of the Trump administration policies. They also believe they think it's appropriate to ease the path of rate cuts, or slow down the path of easing, I should say. Does that concern you about certain sectors, specifically cyclicals, going forward that rallied pretty big after the election, now that we've seen just kind of a change in the tone of the Fed?
No, it actually doesn't, because I think what you do see typically is that cyclicals can do well in higher interest rates environments so long as the economic backdrop supports those higher rates. And I think that is what we're going to get in 2025, which is why I am looking at sectors like the financials, like industrials, as potential winners in the year ahead. So I absolutely think that higher interest rates, and I think the market is actually calibrating for what is a higher neutral rate going forward. And you see that priced into what is expected for the Fed to do this year. They're not even so sure that we're going to get 2 rate cuts in 2025. So I think the market has recalibrated. I think a lot of the pullback that you've seen over the last several weeks has related to this uncertainty about interest rates and the reduction in cuts.
So, Lindsay, that leads us to our question of the day. What is your pick for us today, and why?
So today I'm looking at the financial services sector. We're about to kick off earnings season, as you know, next week, and the banks will lead the charge. In the month of December, since December, this is a sector that has significantly underperformed the S&P 500, down about 5.5% versus a 2% decline in the S&P 500. Earnings expectations have pulled back going into the reporting period, which is always a good sign. Yet this is a sector that is expected to see 15.7% growth in the fourth quarter, which is among the best in the S&P 500. But I also think there's opportunity throughout 2025 when you've got things like stabilizing interest rates. You've got deal making that is expected to pick up in 2025. We saw that with Jeffrey's earnings last night. You've got a resilient consumer. You've got the economy on solid footing and valuations that's reasonable.
Thank you very much.